Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Happy Fed Day. It's Wednesday, December 13th. We have the Fed meeting today. I don't know if you've noticed quite a bit of movement leading into the announcement, but exceptional amounts of movement afterwards. Markets have been moving higher. They continue to push to the upside aggressively, with the S&P finishing the day above 4,700. Interest rates coming down in a big way. The 10-year yield nearing 4%. That's right, 4.00%, not too far below current levels. Cryptocurrencies, a lot of other risk assets, precious metals, gold and silver, all moving to the upside pretty quickly. Very little red that we can identify on the monitors here. So it'll be interesting to see what the takeaway is, right? Now that we've had this obvious optimism leading into this announcement here with November and December, last 6 weeks being incredibly strong off of the October low, today just an exclamation point on that rally. Is this the blow-off end of the move, or just a hint at the Santa Claus magical period that tends to happen at year-end? We have a really good guest today, by the way, TG Watkins of Simpler Trading, live here in our studio in Redmond. So after our market recap, we'll have a conversation with TG, see how he's trying to make sense of this sudden upswing after Powell's press conference. With that in mind, let's get to our market recap and look at how the charts have evolved today. We do want to start with a poll, by the way. We asked you recently on our social media accounts, so make sure you follow us on all the socials and, of course, subscribe to our YouTube channel. You won't miss the next question. And we asked you recently, do you think the S&P 500 will retest its October 2022 low in 2024? Beautiful result, almost a 50-50 split. I am fascinated by this question and by the answers that we got here. So think about it, right? If we're retesting that low, let's go back a little while on the chart of the S&P 500. So I'm basically saying, what are the chances we retest this point right here, S&P 3500, in the next 12 months? 50-50 split, right? Which tells me there are a lot of people, even with the rally that we've had, there's a lot of not so optimism going into the beginning of next year, thinking of the run that we've had, but all the underlying conditions, right? The challenges, the recessionary possibilities, which, Powell in his press conference today did not say it was a foregone conclusion that there was no recession. He said there's always a chance of a recession. I thought was a very appropriate way of answering that question. There's always a possibility. How probable is it? And his comment, which I would agree with, the conditions certainly do not speak of a recession today. But when you're looking out 12 months, a lot can happen between a really strong finish to 1 year and what happens over the next 12 months. Just look at 2021 to 2022. Look what happened as that rotation happened very suddenly, starting in January and really progressing through the first 9 months of 2022. So no guarantee we're going to do that, but about half of you think that's a possibility. What I would encourage you to do, and the reason why I asked that question and phrased it that way, think about what that might mean, right? Think about what the markets could look like over the next 12 months if we do retest those lows. How are you going to manage risk if the market starts to deteriorate? How are you going to lock in gains and make sure you don't leave all of these paper profits in 2023 on the table, right? How do you actually make sure that you cash in on some of those winning positions if the market would rotate against you? What levels, what signals could tell you that 3,500 is getting closer, right? What would tell you that the market's rotating lower? So think about those things as we answer those sorts of questions. Let's continue our market recap and look at how the markets played out. Most of the charts here on the left are going to show the quiet over the last day and a half, and then the big sudden upswing today, and that's right around 230. The S&P 500 was sort of flat leading into the announcement. When the announcement came off, which was right at 2 p.m., market started to move to the upside. Of course, there was language in the official statement that started to give a bit of a change, talking about potential rate lowering in 2024. But overall, the press conference and the upside momentum continued really right into the close. The S&P finishing over 4,700, around 4,707. That's up 1.4% from Tuesday's close. The NASDAQ composite mirroring those returns, about the same to the upside. Mid caps up 2.5%. The small cap S&P 600 index up over 3%. So you're actually seeing an outperformance from some of the smaller stocks, higher beta, higher risk names. And this is an area of the market, of course, that's been lagging behind in 2023, in a small way, closing that gap a bit going into the close today. The VIX pushing higher. So again, this was a volatile day. finishing stronger. But this was not sort of the low vol uptrend that we've experienced for most of the last 6 weeks. This is more of a sudden juiced move to the upside, with the VIX pushing or remaining just above 12 today. Looking at the interest rate environment, a big shift here, right? So bond prices rallied quite a bit during the press conference and soon after. This is pushing yields lower. The entire yield curve coming down on Powell's comments. So the 10-year yield around 4.03%. So we've talked about 5%, which is where we were not too long ago, but boy, it feels like a long time ago now that you're looking at the 10-year yield down nearing 4%. That's down quite a bit from yesterday. The 5-year point right at 4%, and the long bond yield just under 4.2%. Bond prices, of course, going higher, so the TLT is up over 2%. The dollar index down about 0.5%. So one of the few things lower today, besides interest rate, the dollar, right? So weaker dollar sort of giving room for risk assets to move higher. A lot of green on the page of commodities. These are some of the commodity ETFs that we track at StockCharts. The DBC, which is a broad commodity ETF, up about 1.2%. Gold and silver up in a big way as well. Silver prices up about 4.5%. Gold, we've been talking about that pullback after gold tested and really achieved briefly an all-time high above $2,100 an ounce, giving back a lot of those gains recently, but today really pushing right back to the upside. Crude oil prices actually having a rare up day. Oil has been going down as we've covered on the show, as I'm sure you've noted from the chart of WTI Cushing and Brent crude oil on StockCharts. The USO, which is a crude oil ETF, bounced higher today, about 1.8%. Finally, cryptocurrencies participating in all the fun on the upside here today as well. Bitcoin up about just over 3%, we'll call it, 42,825. And Ethereum prices around 2260, and that's up about 2.5% from Tuesday's session. Looking at sectors now, everything has been pretty pristine, pretty bullish. Wow, look at the resounding upswing. It's all market firing on all cylinders. Let's tap the brakes on all of that optimism just for a moment to reflect on the fact that the top 3 sectors today were about as defensive as you could get. If you would ask me, what's a defensive move in the market looks like, I would say it's utilities, real estate, and consumer staples, which are the 3 most defensive sectors, are probably at the top of the list. Now, here's the thing. Everything was up today, right? So it wasn't a down day, and these sectors were sort of safe havens. Everything was up, but the things up the most are some of the more value-oriented and certainly some of the more defensive plays that you could see there. Now, a big thing, of course, is when rates come down, when bonds are not paying as good of a yield as they were a couple of weeks ago. Sort of the bond proxies in the equity market, like utilities and real estate, tend to move higher. So the top 5 sectors, the top half of the leaderboard, are higher yielding sectors. They're sectors that can be a good alternative to bonds. Certainly, when rates were exceptionally low, they were a good potential source of income. We're seeing a rotation back to that theory today. Utilities and real estate both up over 3.5% today. Staples and healthcare tied for third, right around 1.8%. The lagging sectors today were still up a decent amount. So communication services and technology, followed by industrials, both up about 1% from yesterday's close. Let's go to a daily chart of the S&P 500, sort of look at how things played out. So again, I was taught never confuse the top of the page with resistance. So remember, just because we're testing the highest level we've been in over a time period doesn't mean we can't go further. And we've seen that here in the last week with the S&P, coming off of the October low, rallied pretty aggressively. In November, you had that gap higher when the October CPI numbers were reported, and then we really continued to push to the upside. But the last 2 weeks in November, the first week in December, are kind of sideways, right? We sort of moved up to 4,600, and then we stall out. All right, this upside momentum sort of alleviated. The market was overbought as defined by the S&P's RSI reading here at the bottom, came out of that overbought region, sort of felt like we might be in a bit of a stalling out, a bit of a treading water moment to see how things resolve. This week, really to a resounding move to the upside. The S&P powering above 4,600 and following through, right? Today's sort of continued to push to the upside. We're at 4707 here at the close. The RSI for the S&P 500 is almost to 80, almost extremely overbought. It has been a long time since the S&P has been extremely overbought with an RSI above 80. So it really shows you the strength of the move. I was running the numbers using our scanning engine before the show today. I counted about 30% of the S&P 500, about 150 names out of 500 were overbought with an RSI above 70, which tells you that is actually pretty rare that you have that many stocks in our major benchmarks overbought, right? Meaning they've had an extreme move. So while the move today is impressive, I would argue that the conditions we've been talking about leading up to today still very much there and arguably magnified with today's move. A lot of things overbought and sort of remaining there. Some of those stocks that had pulled back a little bit, like financials, maybe industrials, maybe some healthcare, all pushing back to the upside today, right? All sort of continuing that move to the upside. So I think the challenges or the potential pullback still very much a possibility. And I would argue good time when the market's making new highs, when you have blue skies and everything looks good, that's when you want to have your emergency plan well defined. And so let's think about what levels, what moves may suggest a move in the S&P. 4,600, maybe a short-term level to watch, and as long as we hold that, this breakout still appears to have legs for now. That's certainly what we're seeing here. Now, the 10-year yield, of course, has come down quite a bit. I mentioned bonds rallying after the press conference today, after the Fed announcement at 2 p.m. You're seeing the 10-year yield getting down to just above 4%. We are at the 200-day moving average. We actually closed almost exactly at the 200-day moving average today. And we've talked about that as a potential downside target after we hit 5%, started to gap lower when bond prices started to rally off of their October low. We're now there. And I think when you reach a downside objective like this, it's a time to take a step back and just review what the conditions are. Now, overall, I mean, at some point, bond prices probably take a breather. We had a bit of a bounce in rates in the last week, but now we're seeing a re-exertion to the downside. There's no reason why the 10-year yield can't go significantly lower. That's technically possible. I think the challenge is because bonds have had such a run. I think it's the same issue you have with stocks. When things become that overbought, at some point you'd expect a little more meaningful of a pullback in bond prices, a pop in rates. But for now, we're seeing rates going lower. And when you think about what that means door is open for consumer stocks, for retail names, for home builders, for banks to all go higher because the interest rate environment coming a little more hospitable for consumers trying to actually borrow money and spend money in a pretty big way. Let's go to the chart of gold here. We're going to go to the intermarket analysis chart list. Let's look at the GLD. So what's happened is gold prices have had a pretty significant run higher, of course. The GLD was testing resistance around 190, 192. That was the peak in March of 2022, reiterated in May of 2023 when we tested that again. We're right back there, and we have pulled back quite a bit. So when I think about interesting setups, while stocks have sort of pressed to the upside, continue to have that overbought condition, gold actually came down quite a bit from a retest of all-time highs here at the end of November. The RSI pulled back from overbought to down around 40. That's kind of where we were here in early November when we had a pullback from the move around 186. We made a new high after that. So I'm interested to see maybe gold is setting up here for this next move higher. And today is the beginning of that push back to the upside. So when you think about things that are not overbought, that suggest that the momentum has room to grow on the upside, gold is one of those areas potentially there. The GDX, of course, with a similar move. Today's guest, by the way, TG Watkins, I'm going to try and make time to talk about gold in a little bit because we've looked at the gold space before. We'll get an update on where things are at there. You know, the move in defensive sectors is a really interesting one. Again, this is sort of a bond proxy. So when bond yields are super high, right, when the 10-year yield's around 5%, what's the reason to own something like utilities, which is low volatility, so it really doesn't participate so much on the upside. You don't get a lot of capital appreciation, but the real benefit is on the income side, right, the dividend. But when your dividend yield is 3% and a 10-year yield is yielding, a 10-year interest rate is around 5%, not as attractive. That's all of a sudden starting to come back in a little more balance, and higher yielding equities and utilities and real estate and financials all of a sudden seeming like a potential idea here, and potentially and arguably when you get that capital appreciation as well. So one of the things to look at, I would argue, the relative strength in utilities, which for now has not been particularly strong. But when I think about what a pullback might look like, right? If the market is overextended and you see a reversion lower, what signs would tell you that's kind of happening? Well, spike in volatility we've covered with a number of our guests recently. I think a spike in the VIX makes a ton of sense. We've talked about that on the show a couple times here recently. I would say defensive sectors like utilities really improving on a relative basis would be something to look for. The XLRE, by the way, the relative strength is actually starting to improve here, right? Real estate has been an underperforming sector for most of 2023. last 6 weeks it's been outperforming the S&P 500. So look for those improvements. Look for signs that investors are getting defensive. I don't know if we've seen enough of that yet, right? I mean, if you look at the relative performance of consumer discretionary versus staples, still very much favoring offense over defense. Let's finish off looking at some of the individual stocks. There are a lot of things moving today, and I think, again, part of that is a big part of that sort of a macro call, right? Because risk assets are moving higher. If you look at the chart of Apple, pounding out a new 52-week closing high. So Apple for now making a new high for the year, up about 1.7% today. Not quite to the $200 a share level, but really, really close. This is obviously one of the biggest names in the markets, and an uptrend in Apple continuing to make new highs. Arguably, it's hard to imagine how the markets would not be able to go up with that sort of momentum in one of the leading names. What's interesting is as Apple is making new highs, the relative strength, or the RSI that is, could continue to go higher. If we continue to rip higher through the remainder of this week, this momentum obviously could improve. But for now, I'm noting that in the last week, Apple has made a new swing high on weaker momentum. Now, that sort of pattern is what I would argue, what you're trying to look for, right? When the market is in an uptrend, when it feels like everything's going up, you look for overbought conditions because that could suggest a short-term pullback. You look for bearish divergences, which is when a market's making a new high on weaker momentum. I would argue that's kind of what we're seeing with Adobe. Adobe actually finished lower today, down 1.5%, while the major benchmarks obviously having a pretty good afternoon and finishing in a position of strength. Adobe's making new highs November into December, but weaker momentum. The RSI just above 70 in late November, just below 70 as it's making a new high, a new 52-week high here this week. So something maybe to watch for. Some of these leading names that have had really good runs, you start to see that bearish rotation, that bearish momentum divergence. Also want to note a name like Omnicom Group here to finish off our market recap. This is in the communication services sector, and I think this is interesting how it's rallied so beautifully right up to the 200-day moving average. It's overbought as it's reaching that. And so if you ask a technical analyst like myself, what does it mean when we test resistance and we're overbought? I would say most of us would probably answer, that seems like a pullback setup, right? A nice rally into resistance, but we're overbought, arguably means the rally has run its course. We'll see if Omnicom OMC is able to push above that 200-day moving average. I would argue pullback certainly seems more likely than not. That's our market recap for today. Again, trying to get our head around all these movements that we've experienced here after today's Fed meeting. We're going to come back in a minute, talk with TG Watkins of Simpler Trading. How is he making sense of these conditions in terms of breadth, in terms of price analysis, and we'll see what he has in store for the year to come. We'll be back here in a minute.
Every year, investors lose millions because they're buying and selling stocks based on headlines, a friend's latest prediction, or social media hype. StockCharts.com offers you a better way, so you can relax while you stay on top of your investments. StockCharts.com is the world's leading charting and financial analysis platform. Our exclusive technical alert system allows you to set up your alerts in advance and actively monitors thousands of indicators against every stock symbol and index, so you'll be the first to know when a stock is moving up or down. Build your system and set alerts to buy or sell based on the indicators you care about, not the latest headlines or financial gossip from a self-proclaimed expert. Trade with confidence, because at StockCharts.com, better insights lead to better investing. Start your free trial at StockCharts.com.
Hey everyone, welcome back to The Final Bar. I'm Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. We have a great guest today, TG Watkins, actually live in our studio today, which is super fun. We're going to have a good conversation about market conditions. Before we bring TG on, a couple quick announcements. First off, we welcome your comments. We welcome your feedback. We especially value your questions. The mailbag running a little low, and we would love to know what you're running into as you are trying to analyze these markets, as you're trying to navigate this crazy period using technical analysis. Our email is thefinalbar@stockcharts.com. We're on the Twitters @FinalBarSCTV, and on our YouTube channel, of course, you can put a comment in the live Q&A during our live broadcast. Also, you can put a comment below the video that you're watching. Don't forget to like this video and subscribe to our channel while you're here. We would very much appreciate it. Have you picked up your 2024 Stock Traders Almanac yet? If not, now's the time. If you go to store.stockcharts.com, that is our Stock Charts bookstore. We have a lot of great books written by some of the top minds in the markets. Jeff Hirsch has been a frequent guest on StockCharts TV, who's on my show just recently. We talked about a potential outlook for 2024, what an election year looks like. If you want to navigate the markets using seasonal tendencies and make sure you are not caught unawares from cyclical patterns based on seasonality, you want to pick up a Stock Trader's Almanac. If you use the code Almanac30 when you check out, you can get 30% off the listed price. So don't forget to go to the StockCharts bookstore today. Pick up your Stock Trader's Almanac for 2024. I want to welcome on today's guest, TG Watkins. TG is the director of stocks at Simpler Trading. So beneficial to us that he is located here in the Seattle area, and he's live in our studio. TG, good to see you again. How have you been?
You too. Oh, it's been a while, hasn't it?
It has been a little while here. I feel like a lot has happened. We've had a lot of life experiences as investors since August when you were here on the show. Today, obviously, a crazy day, and thanks for boldly coming on the show during on a Fed day.
One of those FOMC days.
It was a day today, and obviously a big move today. How are you sort of getting your head around what's happened leading into this announcement, and then afterwards, we're sort of at everything. Risk assets really pushing to the upside.
Yeah. Well, one of the first things we'll be talking about with the charts is kind of breadth. So the breadth that we've seen since August and then into October and then into now has done a couple full cycles. And so we're watching the number of stocks over their 20-day or 50-day SMAs going from 85% down to 10%. Now we're back up to 85%. And typically, this is the swings that we see in the market. So having today do what it just did with the FOMC, it just seems either a little crazy, or it could be a blow off top. We won't know for a few more days to see how all this is digested.
Right.
But when honestly, I was looking at everything already being pegged to the upside, and everybody as long as possibly could be, the put call ratio is super low. I was just like, where else can this go? And then Jerome Powell comes out. Doesn't say anything too crazy, but I think just confirms more of what the market was seeing basically in November. On top of October for 3 months having bearish sentiment and bearish indicators, we just had a lot of fuel to light this fire off, and we got that. And now it's like, wow, it's amazing to see that we just spiked up vertically today.
Right, aggressively after such a strong November
Very strong.
and beginning of December. We've talked about how so many stocks are overbought right now. I mentioned in the recap about 30% of the S&P currently overbought. If we don't get a meaningful pullback here, I mean, which it seems now less and less likely because we're running out of December, does that mean we're just pushing that pullback forward into January? How does that set us up in the new year, do you think?
I mean, I guess we do. It seems really crazy that here we are, the 13th of December, Santa Claus rally coming early, I guess. Anything can happen. We could get a pullback, and then if we just even have a 5-day rally between Christmas and New Year's, people will still consider that a Santa Claus rally. Sure. We could be in chop, we could digest it. I mean, the market actually went sideways for about a week and a half when it was right up at its previous high, and then it had to digest that. Now it's pushing through. I thought there was a lot of short covering that was probably involved with that, but then we got Jerome Powell coming out right now, and I don't know. It is just like how much more ammunition does the market have?
Right.
Yeah, that's one thing. Now, I am fully on understanding that. I think that in the bigger picture, there is a lot of ammunition because a lot of money can come off the sides, especially with the market reaching new highs, interest rates coming down. There's a lot of money out there, but I didn't expect it to come in when things were already this high. I kind of thought it would start chasing itself, from a better, lower spot.
Yeah, and we'll see what happens, right, with the follow-through tomorrow, the end of this week. I mean, we'll see what sort of hangover move we might have after such a move today, after the run we've already had. Your first chart is looking at the breadth conditions. You mentioned how the breadth is pretty overheated. Can you talk through this chart and just tell us about what the breadth conditions mean for you here in mid-December?
Yeah, the first one there is the 20 days. So the number of stocks over their 20-day SMA. That one can get up there and stay up there for a little bit, because as stocks start to climb, they can stay over the 20-day pretty easily. Yeah. So that's not too much to know, except that it's up there. And what we do look for is when that one starts to fall off, because that will be the first indication that maybe the market's going to start pulling back and names are starting to correct. And we just started to get some of that, but then again, it's right back up.
I guess not.
Yeah, it's right back up there. So it's a little crazy to be seeing that. The ones that, other than the near-term stuff, back and forth, that oscillation, the ones I really do pay attention to is the 50. The 50-day SMA has been a really good bread and butter type thing for me to tell me when the whole picture, the whole tide is going to be changing one way or another. Yeah. And it's up at 84%. I mean, it doesn't, I've never seen it over 90. I've seen it at 89%. And again, it just doesn't get up there for too long. And, we don't know what kind of pullback is going to happen after this, but typically there's a pullback sometime after that. And then you add to it, now we have icing on the cake, we have the 200-day SMA, which is also quite high up there. You know, it's been fun, it's been a great time, but it's just like, is this maybe a blow off top? I can't say yet, but you know, it has me kind of scratching my head because how do we have this explosive move on top of an already really solid 5, almost 6 weeks? It's got kind of that vibe around it.
It's so interesting. So we're still processing the closing data here at StockCharts, but it looks like that indicator, that percent above their 50-day, just touching 90% here at the close with the rally going in there. So it's happening for sure. You brought a couple individual names with us, and again, the world has changed quite actively since you arrived in our office a couple hours ago. But we have Roku and Costco. I'd love for you. These are shorter-term charts, 15-minute charts. But can you talk to us about how you've navigated here a recent period using your Moxie indicators at the bottom, right?
Yeah. Roku was just an example of some of the stocks that had gone up really strongly in November. A lot of stocks also, not just that it was November, but a lot of stocks had earnings, and you just look around, so many of the moves happened because of earnings. And I think that was a definitive change that the market started to see. Numbers came out differently, guidance came out differently, and investors had to really change. And I think a lot of investors were caught flat-footed and probably a lot of short squeezing. That's why these things just popped off the way they did. So a month later, everything is up like this, and then now what? Well, you need to see when these things are going to start pulling back. And this case, the 15-minute time frame for Roku was a pretty good example. The first inkling of when it started to pull back was when price broke the 15-minute 50, which is the magenta colored line. And then after that, people were saying like, oh, is this consolidating? Is this now time to get in? Well, the Moxie indicator, which is the indicator below, you can see it then went below 0. So now energy and momentum is negative. And both lines were staying underneath 0 the entire time, meaning that any moves of price to the upside were false. They were fake outs. And so the Moxie indicator was something that kind of helped you say, nah, I'm not going to trust any moves to the upside. And so between that and also the hourly chart with the Moxie indicator was telling us, let these things settle down. Now, today, I mean, look, we're straight back up again. I'm still not sure. Typically, I like to get in on pullbacks. This is a first move to the upside. Now we're going to have to see how this digests. If price pulls back or even goes sideways and then continues to hold moving averages and go up, all right, I'll go with it. But I kind of want to see what happens after this because it's, the first move can be a fizzle and just kind of roll over.
It reminds me a lot of price gaps that you see around earnings, right? Sort of that there's that gap, and then it's what happens after. And do you see an additional move, or are people selling into that? It's sort of a similar idea with some of these. Costco's another one, right? And again, has had a really impressive run here recently. Talk us through this and how it compares to the first chart.
Yeah, Costco, a little bit less about the 15-minute. I think our charts got a little confused up here. But basically, what I wanted to show was the monthly, weekly, and daily. They look fantastic. Costco had been going sideways, even in a pennant for a long time. And you could just see that it started to break out of the pennant and then move up. It was following the monthly 10 SMA. I think it did a double bottom off of the weekly 21 SMA. And then it just started to go up and up and up. And so we were in that. We caught a nice pullback. You can actually see that last jump up just before here. Yeah, a little bit. There you go. That right there. That was the jump up. We got the pullback perfectly, and then we loaded up and caught that next run to the upside. So great move.
It's impressive. I mean, so tell me this. I mean, with this environment, given the run that we've had, given how so many stocks are overbought, it's super difficult to chase things today. So if you have money to put to work, are you patiently waiting and just seeing what's the next, what sort of reaction here? Are there areas of the market that you see as emerging that you think, okay, this is a good time to take a bet now?
Both of those are yes.
Okay.
Because I'm thinking a couple things. So number one, yes, it's really hard to chase this stuff because even Costco, it's starting to get outside of the outer boundaries that I work with, and that's where you take profits. And human nature is always the same. People are going to come in, they're going to start chasing it. Meanwhile, the experts are selling into them. It's a matter of time. So it's really just kind of when and how. But yeah, it's really tough. This morning I was on at simplertrading.com on our options room and telling people like, there are a lot of stocks, like there's nothing you can do with them right here. It's just not, if you're trying to get a swing entry or an investing type entry, it's just not the right time. If you're day trading or short-term trading, sure, go for it. But otherwise, yes, we have to be patient. Now, if you're saying, are there opportunities out there? Yeah, I think there are. One of the things you had mentioned, gold. Just this morning, I was telling people, look at gold, look at GDX. This morning, just 2 hours before I came here, I was saying, hey, GDX did a nice pullback right to the daily 50. I'm looking for an entry. I don't quite see one yet because things were still going down on the 15-minute time frame even. But then Jerome Powell comes out, says whatever, and just gold shot up. So That looks pretty good to me. I would say gold and GDX and then precious metals are by the dip for me. And I even said that last week when I was on another radio spot.
Yeah. So gold tested all-time highs around $2,100 an ounce. Obviously, it pulled back from that. Gold stocks have come down. Do you think there's a chance we push above there now in the new year?
That's another thing I was talking about. I don't know about timing as far as this year, but I actually referenced it to waste management just because if you look at waste management, which is WM, it's been going sideways for 2 years. And we are just now starting to break out. And if you look at it on a monthly time frame, same thing. It's just now starting to break out. And I said the same thing for gold. Gold cannot get past that level. It has now like a quadruple top that it just can't get past. Maybe this is the time, maybe it's not, but I have a feeling that if it can, in a actually substantial way, then if it can just close above it, I feel like that's going to go because same kind of thing. It's been flagging for so long, and if it can just break out, I don't see what's going to hold it back.
We were talking with Joe Rabel yesterday on the show, who's been a frequent guest, and he pointed out, it wasn't waste management, I forget which name it was, but similar, right? The weekly chart of WM we're looking at, they've had incredible runs in the short term, but I mean, it's still very early on. It could be. If you look at the longer term time frame, there's a lot of upside potential if names like these continue.
Yeah, so. Costco, waste management.
Costco might have been the one. Yeah, that's right. Yeah,
we're starting to see some names really kind of come back.
Yeah. When you look back here, we're almost out of time, TG, but when you think about 2023, we're kind of getting to year end, kind of that natural time to look back and reflect on how things went. What surprised you this year? What do you think was, when you think back about what you learned over the last 12 months, what stands out for you in your process?
I really, this year and last year, I focused a lot on the breadth and then the put-call ratio because in the bear market when we were going down, we went from, oh my gosh, everything was doing great to, oh, everything's just coming right back down. And I tell you, that breadth indicator was really, really helpful to me because I could tell just because everything was going up and looking solid, I could look at this indicator and say, oh my gosh, almost everything is doing too well. And there's probably not much more room for it to go. And I'll tell you, it lined up perfectly. And it also gave me divergences. Last October and this October, I was at the Money Show Halloween weekend in Orlando this year. And I said the same thing in my presentation. I nailed it perfectly. I said, we're starting to see divergences even in our breadth. And so the market made a new low or lower low, and the breadth made a higher low. And I said, I think we're about to light off. And sure enough, 3 days later in November, we popped off, and that's what this run has been about.
Yeah, breadth has been pretty helpful this year. And again, that's what reminds me of how overextended a lot of these breadth readings are now. We'll see what happens. TG, we have to wrap it up there. This has been awesome. Thanks for coming in the studio today and being a frequent guest this year. I hope we can keep this going in the new year, but happy holidays.
Absolutely.
Until then. Folks, that's it. We're going to wrap the show here, but first we go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. You know, when I'm thinking about the markets today, what an incredible move to the upside. And again, a lot of times the short term, that tactical time frame can be a challenge to navigate. You know, who knew how aggressively the markets would rally after the Fed announcement, and Powell's press conference just seemed to push things onward and ever upward into the close. You know, I would say market conditions have been obviously quite strong leading into this week, right? And if you look at my market trend model, look at any sort of long-term analysis of trend, this is all based on weekly exponential moving averages. The 3 time frames that I pay attention to, long-term, medium-term, short-term, have all been bullish, and they've been bullish across the board since early November. So for me, it's a great reminder to assume in this sort of environment, the market is innocent until proven guilty. So I think it's really helpful to follow trends as they're working, to follow upside as long as upside continues or it persists, but be looking, right, really document what would tell you the conditions are changing. I think some of the breadth indicators, some of the volatility metrics can be really helpful to look for changes that could help you understand that a change in the trend in equities is afoot. But overall, of course, further upside to be had today, and it certainly seems like further strength. Chart number 2, I just wanted to talk about the rally that we saw on the defensive side of the ledger today. The big winners today were not technology and communication services. It was some of the more value-oriented stuff, some of those areas of the market that have really been forgotten for much of 2023. And I think that's a really interesting takeaway from today's session in particular. Now, just so you know, we're looking here from the end of July through today's close, and we're looking at the relative strength of technology, consumer staples, utilities, and real estate. Here's technology up, outperforming the S&P 500 by 4.2% since the end of July. We can see in blue real estate, which is actually up 1.4% on a relative basis. Some of these others down quite a bit. Here in green, we have utilities underperforming by about 4%. In red, consumer staples underperforming by over 7%. You've seen now the outperformance in real estate here in the last couple months. you're actually seeing potentially a turn higher in the relative performance of utilities. I would watch some of those defensive sectors. Now that rates are coming down, they are now starting to get a lot more of a bid, which means capital appreciation is happening. And of course, you have a decent dividend yield on a high yielding income oriented stock. Finally, gold. I agree with TG's comments about gold. Nice pullback in gold stocks. It's all about a pullback and looking for that renewed entry point. 50-day simple moving average for now really holding. Today's bounce pushes us back above that $30 level. That was that level we highlighted here in late November when we broke above the 200-day. We broke above 30, but we stalled out. Now that we've tested the 50-day moving average around 29, we're pushing back above the 200-day, back above that 30 point. I think this is a really bullish chart above 30 on the GDX. The momentum overall is strong but not excessive. This could be an area of the market where we have further upside potential. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to TG Watkins of Simpler Trading, being bullish at the moment. There it is. And joining us here live in the studio for StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.